What do you make of Instacart's move here? Should we be worried about its business?
Thanks so much, Emily. So, overall, we're really not worried. I think generally this act of actually reducing the valuation is very much so based on the value of the stock options that the company is issuing to their employees today and any incoming employees. We think this move is really smart for the hiring and recruitment of new employees because generally what employees want to see is the upside in their stock, right? They want to see that there's going to be value accrual once they join the company. So overall, we think that this is a move that made headlines because they were one of the first companies to do it amidst all the volatility in the market. And we just assume that many other companies are going to join suit in this.
But doesn't it mean that anyone who exercised their shares at the original valuation, $39 billion, would be underwater now?
Well, the folks that did exercise their stock options are probably there to hold on and see where the company goes as per their IPO and the plans there. So, overall, with the lack of liquidity now leading up to the IPO, yes, those employees just have to bear with us and hold on. But generally, the tax treatment between the 409A, which is the valuation, right? That's the audit valuation that every company who is private has to do once a year at least between that spread of the 409A and where they actually sell the stock is what's really meaningful. So if we reduce that valuation price, it means that they can have more upside leading up to what they ultimately sell the stock at.
Meantime, we just saw Gopuff planning to cut hundreds of employees, according to a report from The Information, cutting $40 million in cost, 3% of their global workforce. Do you think we're going to see more companies slashing their valuations like Instacart and potentially going through these mass layoffs?
Yeah, Emily. So I truly think that we're about to see a 180 reverse of the great resignation. I think many companies are using this opportunity of the volatility in the market to reduce spend, reduce OPEX, increase their margins, get to profitability, and show both investors, private and public, that they can succeed as they grow, right? And so we do think that we're going to see a lot of companies, further, even though we are expecting the opposite of the great resignation, we expect the talent pool and the recruitment landscape to be just as competitive as it ever was. And so with that being said, companies need to find really compelling ways to recruit and retain. And so with that, they are going to be looking for ways to show the talent pool that's out there that they can have an increase in the value of the stock they're getting issued. So we think there's going to be a lot more of the layoff news coming out. We expect a lot of companies are having conversations with the board of directors to say, what should we do around our valuation? Should we bring it back down to real levels? And then how should we plan ahead for our hiring plans going into the rest of the year? Generally, companies like Instacart last year were really focused on profitability and broke even because of that. And now companies like Instacart are focusing on top line, continuing the focus on growth, and then furthermore, really just focusing on that reduction of spend across the board. So profitability is key, margins are key, and retaining talent from the executive level on down is also incredibly important.
Now, public companies in this space also seeing their stocks slide. Uber and DoorDash, for example, down year to date. I'm curious what you think of Uber's vision here to be the future of driving retail. The idea that they could deliver something faster, for example, than Amazon. And if you think that's going to work?
Well, Uber certainly has the fleet capacity to do so, but these days their fleet is suffering. So I do think they're going to have to revitalize the way that they really incentivize the driver base, and furthermore increase their own margins, because it's not like Uber has always been the company to prove that they understand how to focus on unit economics. So generally, though they have the fleet and logistics down, it's not there to say that they've proven themselves as it relates to being able to scale the logistics side of the business. So I think overall they have a fighting chance, but Amazon has always been the clear winner in this category and is investing a lot in this space. So I think from a bets perspective, we're looking at where Uber can sit, but overall Amazon has always been the leading category winner here.
Is there a cautionary tale here, Andrea, for investors and for employees and prospective employees? I mean, we all thought valuations were getting pretty hot towards the end of last year. And now, at least as you're saying, we're going to see a lot of companies bring those numbers down.
Yes. So overall, I think the cautionary tale to see here is that these companies that are raising money from big crossover funds, and when I say crossover, I mean the funds that are the mutual funds, they're the hedge funds that invest in both private and public companies, and then they really hold on to those positions once the company goes public. Those crossover investors have a war chest of a ton of capital to deploy, and their risk profile is very, very different than a traditional venture investor or retail investor. So, what I say to investors is that we have to really look out to say for the late stage companies that are raising money, and furthermore, just sitting on their own war chest of a balance sheet, those companies really raised a lot of rounds from those crossover investors who can weather the storm and plan on holding on to those positions and setting up arbitrage opportunities long after the company goes public, which is a very different strategy than a traditional venture investor, right? Traditional venture investors, their role is primarily to distribute and cash out once a company has a lockup and the lockup expires. And so I think that tale is that, measure the risk profile, measure risk tolerance, batten down the hatches. But furthermore, we're always going to be looking for companies in the venture community that are investing into growth, increasing their margins, and showing that they can become profitable if and when they want it to be.
So are you saying, Andrea, that some of these big crossover funds, I'll just throw a name out there, like Tiger Global, are they driving up valuations in an unhealthy way?
I think that overall, Tiger Global and many other businesses that are operating similar to theirs in the venture and crossover space were the ones that have had war chests that are sizably larger than most traditional venture funds. And so in the last few years, they've proven that they can be very, very competitive because their strategy is so focused on arbitraging opportunities once companies go public. So overall, I don't think anything Tiger has been doing from an activity perspective is been predicated on them trying to drive up valuations. They've been very competitive for that reason. But for now, it seems like groups like Tiger and others are very much so focused on making sure that they kind of sit back, see where things pan out, and they're not as focused on driving up valuations or putting all their bets in the private markets in recent days.